Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Alright, we just worked out in a recent video what a big deal price rises mean for Tesla and how they're really going to be felt in operating profits, a lot more so than gross profit, which is what we're all here for. Now, the next step for Q2 earnings is to work out the average selling price of each vehicle from each factory. To do this, we need to count back. I need to go through instances of Tesla's website when you could order each vehicle online when the delivery dates were pertaining to Q2. When I discovered around the time of the year where customers were ordering these vehicles that were delivered in Q2, I can then look up the price Tesla were selling them for at that time. I will also need to do this for each model from each factory. Okay, Model Y long range from Fremont was $55,000 when delivered in April, but $58,000 when delivered in June. Therefore, we can take the average between the two prices, with Model Y Fremont at $56,500 average. Of course, we also have the performance model available too, and when we factor that in, the average price rises to $57,000. On to the Model 3. The prices for the standard range did change too. At the start of the quarter, it was $42,000 and then increased to $45,000. The prices of the rest of the Model 3 variants remained constant at that time due to shorter waiting lists. Anyway, when we include long range and performance versions, we have an average price of $47,000 for a Fremont Model 3. Okay, for the Model S and X, I also did the same thing, and I've estimated an average purchase price of $113,000 for them. Alright, that's Fremont taken care of. Moving on to Shanghai. Now, just another example of how complex this quarter is, we also have FOREX to deal with. Yuan dropped about 6% since May against the dollar. Therefore, although the prices have increased domestically in China, the price in US dollars has actually decreased for some variants. Of course, this is just another example of Tesla's awesome local supply chains. Remember, Tesla does everything it can to source locally. Therefore, as much as possible, all the other parts are also in the same currency that the vehicles are selling for. In other words, profit margins will likely remain, but profits in US dollars will decline. However, Tesla did raise their prices still, so despite actual lower ASPs, the margins should still be higher, and hopefully the profits are at least about the same. There are some other knowns as well, like perhaps Tesla hedged for currencies. Also, it is the exchange rate on when they accept delivery, not when they order it, and the currency change happened in the middle of the quarter. And a cheaper yuan also means cheaper batteries when Tesla import LFP cells from China, but still, the US dollar is going to cause potentially more complications down the road. Alright, for Shanghai, I just did exactly the same process of calculating the average selling prices by working back from the delivery dates, but of course had to convert them back to the new US dollar rate. It actually resulted in some variants from China actually reducing in price in US dollars. This still gives us an ASP of $48,500 for the Model Y, which factors in the potential exchange rate discrepancies, and even factoring in some of the time of the lockdowns, and gives us $41,500 for the Model 3. Do you see how much lower Tesla are able to get their costs down in China? China on average do spend less on cars than Americans. Although there are more people in China buying cars, they still don't spend as much as America combined. So Tesla have done what they can to offer lower cost variants, such as an LFP Model Y. They don't even bother selling the long range Model 3 in China anymore, perhaps to save 2170 sales for more profitable vehicles, when there is likely still some good profit in an LFP version. I'd love to know the cost of one LFP Model Y out of Shanghai. As for Berlin and Texas, they are likely the easiest average selling prices to calculate, but we are indeed going to leave them out of this model. We're going to calculate these factories separately. Look, let's face it, this quarter is certainly an anomaly, so I don't have systems in place on how to estimate a quarter like this. I'm just trying to work out the best way I see to do this. It's quite a big project, and I'm not sure too many people would have had time to go through it all in this much detail. It is taking me some time too, hence why I'm doing it in parts to keep you updated. I thought I would take a shot at trying to make the most thorough Q2, so bear with me. I think it will be worth it, especially if you happen to be playing options at all. However, we will add in the sales for revenue purposes to still try and estimate total revenue. I have $60,000 from Model Y from Austin and $67,000 from Berlin. I understand there's also extra available options whenever you buy a Tesla too, but my numbers seem to always be more accurate whenever I use the base prices, so that's what I use. Anyway, when I also include FSD, that takes us to $15.7 billion in revenue. That sounds like kind of a lot. In fact, Q1 revenue was $16.2 billion. That's only a difference of $449 million. Wow, is that due to these price rises? I don't think I've been too bullish on the prices. I've tried to keep them as accurate as possible. And even for FSD, I've kept the price at $10,000 still, which is highly possible that's what it was when they ordered. This is with a 20% adoption rate from Fremont vehicles and just a 5% adoption rate from China, along with 40% deferred revenue. If China was actually 10%, and perhaps the exported vehicles have higher adoption rates maybe, then that would add over $300 million more profit. Just in case you thought a 5% Chinese adoption rate was perhaps on the low side. This quarter does, however, involve the running cost of 2 new factories that Q1 didn't have. That's the difference. Anyway, we're going to leave the 2 new factories out of this episode and move on to work out what the margins will be for the cars produced from the other 2 factories. Now, the margin for cars in Q1 was exactly 30% if we remove regulatory credits. So I'd like to use that as a rough base on these margins for each vehicle. But then when we also factor in the amount the prices have risen since Q1, which will also factor into our margin. We do have the Shanghai lockdowns though. I mean, that is a time when the factories are down with minimal cost, and the additional units they produced to make up for it were ramped up and perhaps at a lower marginal cost. I can't quite get my head around how this affects margin. I think potentially, obviously there was additional cost of the lockdowns whilst being unable to produce vehicles. However, a lot of this may be offset by the sheer production rate Tesla are at in that factory. So I'll take the average margin and increase it by around what we have seen the price increases. Alright, when I add in all the margins for Shanghai and Fremont, we get our gross profit of each factory and vehicle, and it comes to a total of $5 billion gross profit, just from those 2 factories. In case you were wondering, or even if you weren't, you might be interested to know that this profit from the 2 older factories would come to a 33.5% gross profit margin, and that excludes regulatory credits still, and is 3.5% higher than Q1. With regulatory credits, it would be closer to 37% margin. Okay, we are also under the impression costs haven't risen since Q1. In fact, a lot of the prices of the minerals that go into an EV are down since Q1. As you can probably see, this is turning out to be quite a lot of work, but I think I can finish it off in one more video. Personally, I'm quite happy with that revenue and profit we've seen so far. Next, we'll work out the losses from the new factories, and then add in all the other goodies Q2 has to offer us. Bitcoin will be fairly easy to work out, and Tesla may want to use some more regulatory credits this quarter. Last quarter, Tesla had a massive $679 million, which was a bit unexpected. If it comes close to that this quarter, it would really help. However, that Q1 regulatory credit was twice as high as the previous quarter, so we can't really rely on a large credit. Anyway, I am getting there, and now we've calculated that the other 2 factories have contributed around $5 billion in gross profit, that will also certainly help. And although Q1 had a very large regulatory credit, it also had a very large R&D expenditure. This might be due to further progress in FSD. I believe Elon said that is where the majority of R&D does go, and it is possible, as we are making closer progress, then maybe R&D for FSD is getting more expensive for the finishing touches. Equally, Tesla have been making layoffs in the FSD department. Also, let's not forget that Tesla have been making some layoffs in other areas too, so it's possible OPEX is down slightly. I think Tesla may have cut costs slightly in Q2, trimming fat for a recession. Anyway, we should get some more useful figures in the next video. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.